Hello, this is Dale. Let's continue our education of my three principal method of trading. This is a laser focused system to unlock profits in any markets. Let's continue our discussion in part 11. What I'm going to be talking about is 4 facts of the market that the strategy that we use is based on. It shows the power of this strategy. My name is Dale Brethauer. I've been a trader for 35 plus years. Right now, I have a passion for teaching people how to be a success in this very difficult arena. The founder and head trader at www.optionsinfinity.com, which I believe is the very best option education website available today. The three principal method of trading is very powerful because of 4 facts about the market that support and show this power. These are facts of the market. The market doesn't have a lot of 100% this but these facts are very high percentages, and they give us the edge. The first fact is that 95% of all prices stay within the plus or minus 2 standard deviation on the regression channel. The second fact is when implied volatility, which is used to establish our credit spread strike prices, is higher than historical volatility, it is in our advantage because the premiums are inflated during that time frame, and we are sellers of options. Even though we're buying one further out of the money for protection, we make our money by selling the option. And when the premiums are inflated, that's to our advantage. The third fact is our trade setups have an 80 to 90% probability based on option delta. And the last fact is that 82.6% of all options out of the money options expire worthless. I studied 5 markets to get this information, plus I had information from the CME to determine this last fact. Fact number 1, 95% of all prices stay within the plus or minus 2 standard deviation on the regression channel. This then is a reminder of the regression channel. This is a price chart of Amazon, and you can see how the regression line right here is determined by 50% of the price being above the line, 50% being below the line. Once the regression line is established, which is a great trend line, you take plus or minus 1 standard deviation and then plus or minus 2 standard deviation. And the fact is that 95% of all prices will be contained within this gold line of the plus or minus 2 standard deviation. Notice how over a year's period, Amazon migrated to around the plus 2 where it became overbought, and then came all the way down to the minus 2 where it became oversold. And then it worked its way mostly all the way up to the plus 2. And this is the way the stock market acts. Again, looking at the statistical bell-shaped curve where the mean is right here, plus or minus 1 standard deviation, there's 68.2% of all prices contained within here. And then when you go to the plus or minus 2, that's a little bit greater than 95%. Now, you do occasionally have outliers here, but the nice thing about outliers is you know at some point in time they will revert back to the mean. And that's the point where we want to get on and put on our vertical spreads. This is a very interesting graph. This is the distribution of daily percent change of the Dow since 1900. And notice how the chart shows that plus or minus 2 standard deviations, which is right here and right here, have held the market since 1900 within a very tight range. This is our huge edge. Fact number 2, when implied volatility, which is used to establish our credit spread strike prices, is higher than historical volatility, it's in our advantage. And this comes from Investopedia. What they were saying, they went on to say that the higher than average premiums shift to the advantage of the option writers when the historical volatility is when the implied volatility is higher than the historical volatility. Because we're selling to open a position at inflated premiums, even though we're buying one further out for protection. This is a recent chart of the historical volatility as of February 10th, 2020. And you can see it was at 15.5. We just put on an implied, we just put on a PepsiCo Leap, and the implied volatility for that option chain was at 19.3%. Historical 15, implied 19.3. These premiums that we have down here out of the money are based on time value, and they are inflated due to this fact. That is our advantage number 2. Fact number 3, our trade setups have an 80 to 90% probability based on option delta. Strike prices are based on implied volatility, and they usually fall between 0.1 and 0.2 on the delta. This was one we set up for the SPX, where we set up a vertical spread right around 2880, and you'll see that the delta was 0.17. Well, a bear call for the same period of time, right around the 2995, had a delta of 0.14. This is where you would have set up a bear call, and this is where you would have set up the bull put. Delta is a ratio comparing the change in the price of the stock to the corresponding change in the price of the option. For example, if a stock option has a delta value of 0.65, this means that the underlying stock, when it increases $1 per share, the option will rise by 65 cents per share. This is something that I learned early on. It's also an easy way to view the probability of an option expiring worthless. In other words, a 0.2 delta means 80% of the time this option will expire worthless. Fact number 4, 82.6% of all options expire worthless for 5 markets that I studied. Again, this is information from Investopedia. While there are certainly many viable option buying strategies available to traders, option expiration data obtained from the CME covering a 3-year period suggests that buyers are fighting against the odds. Based on data obtained from the CME, I analyzed 5 major option markets: the S&P 500, euro dollars, Japanese yen, live cattle, and the NASDAQ 100. And discovered that 4 out of 5 out of the money options expired worthless. In fact, the put options alone expired 82.6% on these 5 markets studied. In summary, the 3 principal trading strategy. There are 4 facts about the market that support and show the power of the 3 principal trading strategy. There 95% of all prices stay within the plus or minus 2 standard deviation of the regression channel. When implied volatility is higher than historical volatility, it's in our advantage. Our trade setups have an 80 to 90% probability based on delta. And 82.6% of all out of the money options expire worthless. If you found this video helpful, we're just about finished with our series. We have one more lesson to be had. In the meantime, if you'd like to explore more about Options Infinity, just simply go to our website. Our website is www.optionsinfinity.com. Just scroll down on the home page and you'll see a free guide on the 3 principal method. It's our blueprint. You'll learn pretty much everything I've been talking about here, but we've got it in PDF form. It requires nothing other than clicking this button to view this PDF file. If after hearing me and listening to me and looking at this and practicing, if you decide that you want to follow a professional and follow how I trade, what you want to do is come down here and join our membership. Members get every week, there's a 1-hour meetup webinar that's taught by me where we talk about, I usually give a lesson and we talk about all the trades that we have on there. And there's plenty of time for member questions. Then on Tuesday and Sunday evening, I put on member reviews. These reviews were voted the top 10 blog worldwide by FeedSpot. And the biggest thing, you can follow me because when I see something, I'm going to send out an alert to you, both text and email, on the weekly, monthly, and leap vertical spreads, stocks, and Forex. And lastly, all trades are posted. We don't hide anything. Everything we talk about is posted on the website. For the last 10 years, we've had 75% winners. And when we win more than when we lose. This is a robust strategy. I hope you take advantage and join us. Bye-bye now.